Hi everyone, and welcome to this 30-minute quick-fire run-through about the ECB's new guidelines around intraday liquidity risk. Nick and I are going to whip you through this. We will take questions as we go if you want to throw them up in the comments. I've actually had a few sent in advance already, so we'll pick those up at the end if necessary, and we'll just work our way through it. Planix, we've been in this intraday space, well, frankly, forever, right from the beginning of the journey and the agenda. We've got solutions that are used by banks in the Eurozone and beyond. Nick, who's with me today, he's been on multiple sides of the fence here, including actually at banks, building out intraday capability that's kept the regulator and the bank very happy. So lots to learn from Nick, and hopefully I can chip in as well. I'm just going to start with a bit of a why do we think regulators care about intraday liquidity? And then we'll get into specifically around the ECB. So let's go back to what I'm going to decide is the beginning. And I'm going to talk about the financial crash 2007-8. Lehman Brothers is the classic example. They used to have an enormous overdraft credit line facility, up to 10 billion across people like JP Morgan for dollars, HSBC for sterling. And that was absolutely fine. They used the overdraft. At the end of the day, they'd pay it all back. Everyone was happy. The problem came when those banks and others started to think maybe Lehman's are a little bit of a risk here, and giving them billions of dollars overdraft during the day could cause us an issue if Lehman's get into trouble and can't pay us back. So they started to ask for those overdrafts to be collateralized. And what Lehman's realized is the only way they could provide the collateral was to raid what we would now call our LCR buffer, the buffer that's supposed to be there for the run on the bank. And therefore, they didn't have enough collateral to both cover run on the bank stuff, which is what it's there for, and to support payments throughout the day. And they went technically bankrupt, Chapter 11, and so on. What came out of that and the wider crash was the 2008 Sound Principles for Liquidity Management. That included commentary around you've got to be on top of your intraday risks. Fast forward to 2013, BCBS 248 comes out, which is a little bit more formalized about making sure you tell your regulators what your intraday peak use of liquidity is. In other words, how big those overdrafts may be, so you can size buffers and so on. And since 2013, you've seen quite a lot of difference across the globe about the way different supervisors have decided to address the problem. If you look in the UK, where Nick and I are sitting today, the PRA has always been quite active on this, published some pretty good guidance as to what they expect. The Fed has done its own thing, sometimes quietly, sometimes more publicly. Most recently, they've done horizontal reviews of intraday liquidity about how the foreign-owned banks are faring in the US, which has driven some change. ECB we'll talk about in a second, but historically, I think it's about 2019 when they started to explicitly include intraday as a time period they wanted you to look at. In Canada, we've seen a lot of noise very recently as they're bringing out their new intraday regime, and we expect to see more in the next week or two. In Switzerland, they brought out principles for intraday management, and we could go on. Point being, regulators are doing their own thing, and really the best regulators, what they tend to come out with is, this isn't just about reporting. It's not just about telling me your intraday usage. It's about making sure you're in control of intraday so you can cope with problems as they come out. And if we bookend the history, Lehman's in 2008, Credit Suisse in 2023 failed for a very similar reason. They didn't have enough liquidity in the form of buffers to be able to both fund their payments throughout the day when they wanted to prove to the world they're safe, so wanted to pay early, and also have enough liquidity to cope with the run on the bank that was happening. So for exactly the same reason in Lehman Brothers, it's intraday liquidity at the very end of it that causes the problem. So that's the background, that's the history. Nick, do you want to tell us a little bit more about what the ECB specifically has been up to and what the most recent news is?
Yeah, sure. Thanks, Pete, and hi, everyone. So we kind of know from an ECB point of view, and you pointed this out just a minute ago, Pete, that different regulators at different stages, focuses have been elsewhere at times. But we know from speaking to multiple banks and other people in the industry that the ECB has been doing this kind of horizontal review across many of the banks. And basically, whilst intraday liquidity risk has always been there as a topic, you rightly pointed out, some do things slightly better than others. Some take it, it's very much embedded in their practices already. Recent events has really, like Credit Suisse, has really raised the bar and the profile and the kind of, I guess, the appetite to get on top of this once and for all. And that's really been kind of around the kind of things that are just moving faster now. I think it's just amplifying things even more. And so that's why the ECB, in much of their conversations now, this has prompted them for how they call it, this thematic review, which ultimately has resulted in them coming out with and identifying several where they see sound practices with respect to intraday liquidity risks. And there's a couple of things to point out here as well. So kind of these practices are deemed very important now. So clearly the ECB and even the joint supervisory teams, this is going to be a focus going forward now. So previously it might not have been top of the tree in terms of priorities. It certainly is getting that way now based upon the items that I've told you. And also it builds on existing standards. So Pete, you kind of pointed out that, you know, the sound principles has always been there. There's always been reference to intraday liquidity. Again, that's why we see different maturity levels at the moment, even across the Euro region. So it's been there. It's just more granular information now, which is going to help many institutions out. So that's what's happened. Last week, the paper was produced or kind of released to the market. And now this is a thing that we're going to need to start addressing as an industry. So what is it? What's come out of that? Well, in essence, there's what the ECB are calling principles, so sound principles. There's 7 of those. You've mostly got in excess of 60 practices across the 7 principles. And those principles range from kind of risk management, governance, through to do you understand your sources of your liquidity and how quickly you can mobilize them. But we'll go on to that in more detail in a minute. And interestingly, there's a categorization. And there's 2 main buckets. One is what's deemed key, and key means fundamental, or in my language, that means kind of the base level. So this is the bare minimum that you should be doing or at least thinking about. And then there's good, which means advanced or aspirational. Now, I wouldn't have personally chosen aspirational because how does anyone get to that point and at what stage? Now, what hasn't come out of this is where you need to fit into that. I don't think it will be a one size fits all. I think there is reference to you need to assess your own individual circumstances. So much that you said, Pete, this isn't a tick box exercise like it can be sometimes. If you pick all the key items, that might not be sufficient for you. You may need to be more along the trajectory of an advanced kind of practice. So you really do need to speak to the supervisors. That's what you're going to have to do. But more importantly, review it within your own organization, your own vulnerabilities, where you think your own risks may materialize. And that's the key. So what do you do with these principles? Well, ultimately, they're a key and a guide for you as a bank to either assess where you're up against right now, if you have something in place, or start to think about the designing of your kind of intraday liquidity risk policy and where your institution needs to go. So a couple of more things before I get onto those in more detail. I would say this is worth noting that this is now going to be served as somewhat as an aid memoir for supervisors. So again, when they come and review you, not that it's going to be a tick in exercise, but there's going to be reference to this. This is out there in the public domain now. This is an expectation and a bare minimum. And the last point I'd say as well, which is key, and I've heard it elsewhere, and people don't take it maybe as seriously as they need to, is it's not just about your material currencies, it's your non-material, which is just as important. So you often hear, oh, I'm fine because I've got sterling or euro or dollars. Actually, you could argue that a lot of the risk is in the non-material currency. So again, that's called out specifically. So again, around about the principles, and I will ask you something in a minute, Pete, is that I've kind of looked at the principles and the practices, and there's, for me, 3 key buckets. One is around kind of a framework and the governance, the risk, and I'll talk about that a bit more later. There's capabilities. So how do you go about this, and what should you be thinking about? What systems should you be looking for? There's elements of general procedures and practices, and we won't talk about that too much, but certainly capabilities is a key factor that's called out in a number of different areas within the paper. And then finally, there's sources. So really, in order to manage your intraday liquidity, you need to understand your sources, how much you've got and how quickly you can mobilize them, not just in a BAU situation, but a stress as well. So that's really high level what's been going on in the ECB and why they're interested in this, and why you need to act now. Pete, I've mentioned a couple of the key bucketing areas. I think we could have done this a number of ways, but it'd be good to get your view on the capability side of things. And so I'll hand back across to you to get your opinion on that.
Yeah, cheers for that. Actually, what you might want to do, Nick, while I'm talking is, do you want to just stick in the comments the link to the actual guidance? So just in case anybody's not got it to hand. Because the really, just picking up on what you've said, the thing that I think is incredibly helpful today compared to where we were this time last week is if you are a bank and you're saying, the regulators are telling me intraday is important, but I don't really know what they want me to do. What does good look like? The answer's there, because they've actually been very explicit about what they expect to see when they come in to look at what you can do. So if you look at the bucket that you described as, we'll just call them capabilities, these are the things that you should be able to do. If you walk in the office today, can people do this? I'm going to talk about the 4 principles that sit in there. There's one that's called monitoring. So monitoring is, frankly, in real time, you should have a tool that tells you what is going on in its basic terms. So across all of your accounts that are important, and those accounts are both cash and securities, they're very clear that understanding your collateral positions are important as well as just cash. That cash, as Nick said, is not just your big currency that you might clear in, it's the other large currencies where you may use agents, and it can also be making sure you're at least covered for your non-material currencies. That tool should be used by multiple teams. There's descriptions in there about how Treasury might take responsibility for some things and cash management actually doing something to actually generate the information as well. So a cross-organizational tool this is now. It should be alerting you, because if things are happening in real time, you can be told about it. And also it's very explicit about saying you want to be able to understand as settlement takes place throughout the day, the system should be telling you that. So in other words, doing that reconciliation in real time between what you think is going to happen today based upon what's booked with what's actually happening in real time on the real world accounts. They're very explicit about it. So first bit, monitoring, you need a real-time tool that does everything that I've just said. The next bucket of principle is, they call it forecasting. Now, most organizations I've gone into would be doing forecasting and have done for ages. If by forecasting you mean, where do I think I'm going to finish today based upon everything I expect to happen? And the everything I expect to happen is a combination of stuff I might predict that customers do based upon just historical patterns and knowledge, plus anything that's booked in the system that is going to settle today. It could be a securities trade, it could be a loan that's maturing, it could be a money market deal, whatever. So far, same old, except what the document's telling you is you can't just rely on somebody with grey hair like me or maybe Nick, who's, well, I know how these things happen because I've been here for so long that I know that throughout the day this is going to go on. They want you to actually use the tools and use data to understand what's going to happen and how it changes throughout the day. And they're quite explicitly saying they expect the models you're using to predict settlement to update based upon the world we're in now. So there's a big chunk on forecasting, nice overlap here with monitoring, because that monitoring capability is monitoring how your forecast is going. Third area I wanted to talk about is throttling, basically managing your payment outflows. And this is really interesting because they're very explicit here. They demand that you have the capability to prioritize payments and choose which payments to release when. The reason I use the word throttling is potentially throttling payments back if your liquidity levels suggest that you've got more time critical payments that need to go out of the door before the lower priority payments. And there's quite a lot of explicit statements in there, which is really interesting for those banking organizations I've spoken to in the past that say, I don't really think we should be throttling. And in fact, if we did, I think the regulator might tell me off. Now, I've heard that a few times, and there's a difference between doing your own throttling, using your own mechanisms, rather than using the tools that maybe a clearing system provides. So here in the UK, for example, if you're clearing in CHAPS, you want to use the tools within CHAPS. That's what the regulator, Bank of England, are telling you to do, rather than doing all your throttling outside before payments are presented to CHAPS. But that's a subtlety. The point is you have to have the capability. It's a big part of your controls. And then the final one I wanted to pull out was the one that talks, the principle, it's all about stress and stress testing. And they're very explicit again in something I've heard some banks in the past say is not important to them, which is you do need an intraday liquidity buffer. In other words, like Credit Suisse found, you need a buffer set aside specifically to get you out of a problem intraday, separate from any buffer you might be holding for the run on the bank type of stress. This is to make sure you can make payments when you really need to, if a stress happens. And the sort of stresses they're talking about are things like payment flows at a changing time. Maybe somebody can't pay you when they normally do. It could be I've not got access to a credit line as I normally would because collateral's been devalued, or the provider of my credit line actually is in trouble themselves. It can be that the values of your payments change. Maybe the margin calls have gone up or something like that. So being very explicit that you should be able to model these. You should be able to do them daily. So stress testing yesterday's data, I'll do that today to make sure nothing's changed that quickly. And a recognition that this is multi-currency. You can't just do your stress testing in your own home currency. There are other currencies you need to cover. So lots on stress as well. So in terms of capabilities, make sure you've got a tool that can monitor in real time, that takes into account forecasting, that gives you the ability to throttle, and that allows you to do stress testing. You need that as the minimum, otherwise you're going to be criticised. Nick, that was part of the challenge, I think.
Yes, very much part of the challenge. Yeah. So I think one of the areas I covered at the start was the kind of the framework, the governance. So I'll touch upon that. And as you say, Pete, there's a lot around capabilities. There's a lot around how do you do things and have you got the appropriate procedures in place. So all that is kind of wrapped up from the policy, the framework, the governance, or what do you want to call it. So I thought I'd give some flavours of what you should be including or what you should be thinking around the risk management and the governance piece. And I always start off, and I was glad at the guidelines because it kind of backed up what I've been saying to people for a number of years, that there's key things you need to cater for. So first and foremost, and this shouldn't be too dissimilar to what you have in your other kind of liquidity risk kind of policies or frameworks. It might be very much intrinsically linked to those policies and procedures, but you need to make sure that there's no conflict now between them. You don't want to go over a limit on one, but your intraday policy might say something different. So there's a key to looking and aligning to your existing policies and practices. But broadly speaking, what would I be thinking about? And this is what the ECB have been saying as well. Clearly, in a policy, you need to be thinking about, well, your scope, your introduction, what are your key group principles around managing liquidity risk? What's the kind of relevant regulations? We've called some out, the ECB called some out. So everyone understands around the purpose, the rationale, and the scope of what you're trying to achieve here. And then clearly definition of your risk. So that's understood across the organization from top to bottom. Everyone understands what the organization is trying to achieve. What do I mean with things like intraday or settlements, and provide examples. So again, everyone's very clear what intraday matters and means to them throughout the organization. A key bit that's called out from the ECB, and I kind of wholeheartedly agree, governance is huge. Having the 3 lines of defense is very, very key. Having areas involved across the spectrum. So it's not just one single area that this is going to impact ultimately around those capabilities you was mentioning, Pete, but actually there's various levels of expertise and input across the organization. So that could be operations, treasury, risk, possibly audit at some point from that perspective. So you really do need to start thinking about roles and responsibilities, who's doing what, include things like races, and have escalation processes in place. And that also does include going up to like ALCO as well. Very much key and called out by the ECB, where needed and where appropriate, the escalation is in place to go up to a more senior level. And then you can start putting around things like limits. You've touched upon the capabilities, Pete. What are those limits? How do we want to manage our intraday liquidity? So that's kind of some main elements around the governance piece, which is key. And then you've got more of your framework. You need to be able to understand and identify where your risks are. And that's not just we haven't got any intraday risk, which I've heard before as well. You've got to at least assess that. And then you've got to be able to understand, well, even if you have or haven't, how do you measure? How do you know? How do you manage these, as you touched upon? The managing of those outflows, Pete, is really important. But how do you go about it as an institution, which goes hand in hand with the monitoring aspect? You can't manage if you can't monitor. So you need to have that. And then finally, where's your reporting? You know, good practice is reporting. You know, did something happen today that maybe you didn't anticipate, which is key? Is it flows that you weren't told about? So again, it's a constant evolution of your procedures, your processes, but it's all very captured. And then finally, a couple of last bits is stress testing key, as you pointed out there, Pete. You need to kind of understand what's your analysis, what's your approach, and what's the impact on those scenarios as well. What could change it? What's your methodology? So again, it's clear, you can evidence it to the regulator or the supervisor when they come, quite frankly, knocking on your door and asking you to show them what your policies and procedure are. Breach is an escalation. I don't like the word breach, but breach is an escalation. So what are you going to do in a certain scenario? What if you've got a pot of liquidity you want to manage to? What if you're getting close to that? What if you need to go over it for whatever reason? What is that escalation process? Who is it and in what scenarios? And then a key bit as well that is often missed out, and actually it wasn't particularly called out in the ECB, is around the maintenance of that policy. When you must have regular reviews, you know, that could be annually. But what's the process for that? What's a trigger point for having a review earlier than the 12 months in my example? That could be market events. Your liquidity profile may have changed. So that's all key elements that the ECB would like you to think about, but actually is really, really sound practice around this. And then my final points will be, you need to be able to cover and look at contingency funding planning. What does that mean for you? How would you go about things in a certain situation, which is nicely linked into the stress testing that you mentioned there, Pete. So as an overall, that's the key pieces that are called out of the ECB, but also we know from speaking to people, that's what kind of a good, should I say, policy and framework for intraday liquidity looks like.
So I guess wrapping up,
yeah.
If I'm in a bank, what do I do next? I'd say it obviously depends where I am in the world. If I'm in one of the 113 ECB jointly supervised banks, I'd be more urgently looking at this than if I was somewhere in a different continent. However, even if you're not one of the 113, but you're in the Eurozone, this sort of best practice is going to filter down to you. The local regulators will turn to this as their checklist of what they expect. Similarly, if you have any entities in the wider European Economic Area, then this is again a great checklist. There's a lot of overlap actually across into the UK about what the PRA look for. And frankly, if you're in any other jurisdiction around the world, it's a really useful list of things that tell you what are good practices around intraday. So it applies to everybody at different levels. Have a read of the document. We've put the link in here. Have a chat with us. If you want to chew the fat on anything, give us a shout. I'm happy to talk. I'd also think about getting a cross-functional team involved. This isn't just a treasury problem. It's not just a cash management problem. It's not just a liquidity risk problem. It's everybody's problem, and more politely, an opportunity to get better. Get ready to talk to your supervisor about it, because if it's not today, it'll be sometime in the next 12, 18 months. You may get a visit where they're expecting you to show your capabilities. I'd do a gap analysis of these principles and of the elements, the recommendations within the principles. Can we do them? If not, how hard would it be to get there? And that would lead you into an improvement plan. How can you improve? And also probably makes or save some money along the way, because one of the things that we know from our work with our clients is that you might get into improving intraday because a regulator's outside the door with a big stick, but in doing so and getting better data, you often can make significant improvements. The most obvious example would be if you're in a much better shape to understand where your cash is sitting at any moment, you'll make much better decisions about where to place that cash and hopefully earn some interest rather than have money lying around doing nothing, or at worse, paying interest if you're short. So that's the overall recommendations. I'm conscious we've got 5 minutes left. We've had some questions, so let's flip straight to those. The first one comes from Dan Feeney, which is an interesting one around almost like what causes the crisis, pointing out that deposit insurance levels, are they the right level? So when customers are thinking, oh my word, there's a bank here that's looking like it's in trouble, I better whip my deposits out. can that problem go away if the government stand behind said banks by having higher deposit levels, insurance levels? I'd say that for the banks that are more retail focused, then yes, that will stem the leakage and therefore may get you out of trouble before it turns into a crisis. But if you look at someone like SVB, there's no way the government are going to stand behind some of the deposit levels that those tech companies had with the bank. They're into the multiple millions rather than the UK. I know it's 85,000 sterling. So if you're not just a simple retail bank, then you're going to have to get your intraday strategies right in case you get a run on the bank that causes the intraday crisis.
Pete, just to add on to that, I think I've heard, I think it might have been even the Fed that came out and said, we shouldn't, it's not ideal, but banks can fail. If they've got poor practices and so on and so forth, we shouldn't want those banks within the, the kind of the ecosystem as well. So whilst you want to protect your customers, clearly, if a bank's operating in such a way and not taking their risks seriously, for argument's sake, is it such a bad thing? I know that's a bit of a personal.
You don't want to be the bank that fails, but ultimately banks do fail. The job of a regulator, as one once said to me, is our job is not to stop an individual bank failing; it's to stop a bank failure becoming systemic across the economy. So, and to be fair, although a few banks failed back in 2023, and obviously Credit Suisse being the big one, it didn't ripple into a massive crisis that pulled multiple banks down in multiple different countries. And that's what this type of regulation is there to do. Next question, Nick, it's less of a question, perhaps more of a comment from Hugo, which is remediating breaches. In other words, if you can't do some of this stuff, what do you do? Well, as my point was, you can turn this into an opportunity, as Hugo says. So if you can optimize your liquidity, you end up in a better space. You're not having to pledge as much collateral, perhaps, for a credit line. You're not having to hold as much HQLA. You're able to do more with the liquidity you have. Nick,
and on the remediation bit, I was going to, Hugo's exactly right. I think that's part of that governance. Whether it's then you're reporting, whether it's on the day, whether you can maybe foresee some of these kind of problems or liquidity needs coming up. If you can't, then that part of that whole governance and the reporting is to what can you do about it? How can you be better in the future? And that goes that evolution, the capabilities that you need. And then like Hugo, like you've just said, certainly this isn't just around the reg. You should take that as an opportunity to, there may be a revenue opportunity in there or an opportunity cost reduction. So it's not just a reg thing. It will make the institution far better and strategic, I'd say, as well.
2 minutes less than. I had a question in a bit of dialogue in advance. I'm going to throw your way, Nick. It's in that whole area of payment throttling, and somebody's saying, look, I don't think we should, as in what is the right thing to do, I don't think we should be holding payments back. If everybody throttles the payments back, nobody gets paid, and then we end up in a crisis. What's your commentary on that? I mean, you've been at the sharp end of this. Do you think payment throttling does have a role?
Yes, I do, but it needs to be done in the right way. So there's a couple of questions in there. One, it could be a bit of a big bang approach, and that's not good. I think that's where you'll find that why the Bank of England, certainly for the UK, implemented their solution. They could see that coming. I do think it's a very useful tool. It's very much called out in Principle 8. It's very much called out in the new ECB kind of guidance on best practice as well. And you might say that I've got the cash, I don't need to hold things back. But actually, if I look at it from a lens of risk, I'm managing my risks appropriately. What happens if there's a stress? What's your capability? That's where that kind of ability to manage your payments really comes into its own. You've also, as we've touched upon, there is a kind of a usage kind of saving that, and that works its way into a buffer, but that may be less so. You just ensure the right payments settle at the right time. There's often references, as you've seen, around time-sensitive payments. Now, I could have lots of payments that use all my liquidity. Something might happen unexpectedly. So I need to have the controls and the tools to make sure the right liquidity is at the right time. The other bit, again, looking at an opportunity, you do see and you have seen, some banks or institutions might want to use that as a product as well. I know I've got a preferential rate with a client to settle their payments by a certain time. It could be as simple as that. So done in the right way, it's a very, very good tool. Obviously, there's things in the market around throughput, etc., that means you manage it. But the key, my last point would be understanding where you fit within the ecosystem, because you do not want to be putting systemic risk there. But it can be done, and it can be a very useful tool, and is called out by the regulators as well.
Cheers, Nick. Look, we're bang on 12:30 UK time, 1:30 in Europe. We've got a comment from Nick Nichols, which I think is a great way of just finishing this off. He's made the point that it's good to see another regulator recognising best practice. And that's the way we should look at this. This shouldn't be seen as a stick to beat you, oh my word, I've got to do all these things. Instead, it's here's the things that you should be doing as a bank. Here's the useful checklist. Get on and do. Thanks very much, everybody. Good to be involved in the discussion, and I hope to see you again soon.